Increased volatility can cause many investors to second-guess their investment strategies and begin making decisions out of fear. In this video, you'll learn how to avoid these behaviors and maintain perspective when the market gets rough. Market timing is trying to buy a stock at the bottom and sell it at the top. Performing this consistently is very difficult and potentially very dangerous. Investors who attempt this may succeed some of the time, but continual success is very hard. And these investors may not be in the market when a rally occurs. This chart shows you how your returns could have been affected if you weren't invested during the top-performing months. The annual results of the S&P 500 are shown in dark green. The light green bar shows you what your return would have been if you missed the best month of that year. In this first year, if you held on to your stocks, you would have had small but positive returns. However, if you were trying to time the market, you might have missed the best month, and as a result would have seen negative returns. In this year, the market suffered a loss. A bear market can often prompt investors to try timing the markets. If your timing was off and you missed the best month, you would have suffered even greater losses. The following year had even more tragic results. You can see over and over again how market timing could negatively impact your returns. When a market downturn does occur, it's important to be aware of the long term. This can help you maintain perspective because, historically, stocks have had consistently positive returns. In the past, even when the stock market has turned bearish, stocks historically have recovered and reached new heights. For example, starting in 1973, the stock market turned bearish and lost over 42% of its value by the time it hit bottom. However, the following period experienced growth of 86%. Each market contraction involved a loss and an eventual recovery, often followed by the market reaching new heights. Some keys to handling market volatility may be a diversified portfolio and a long-term perspective. Let's look at another example. Compare these three portfolios. One is an all-stock portfolio, another is an all-bond portfolio, and the final portfolio is 50% stocks and 50% bonds. Let's look at their performance over these 3 years. You can see that when the market fell, bonds were the better investment. However, if we expand the time frame to 2010, stocks outperformed bonds. Stocks had some very rocky times, but in the long run, the all-stock portfolio outperformed the 100% bonds portfolio. Now compare the performance of the stock and bond portfolios with the 50-50 portfolio. While this portfolio didn't see as great of returns as the all-stock portfolio, the ride was a lot easier to stomach. As you learned, market timing is very difficult, which is why a diversified portfolio and a long-term perspective can help reduce the fear that may accompany a volatile market. This could mean you're likely to be in the market when the best performing months occur.